All right, so today we're gonna have the Bed Bath & Beyond valuation. Here we go. So Bed Bath & Beyond is segmented into 4 different divisions. The biggest one being Bed Bath & Beyond, where they sell their bedding, bath, kitchen, food prep items. Bye Bye Baby sells baby essentials. Harmon Health sells leading name brand, private label, personal care, and beauty brands. Whatever they end up doing there. It's like a Walgreens basically. Decorist is an online interior design company. Biggest problem being that it's completely free of charge. I mean, we can't be having that. It's not viable. Locations. Fiscal 2018, they had around 1,533 locations, with most of them being Bed Bath & Beyond retailers. Second most being Cost Plus Market, followed by Christmas Tree Shops, Harmon, and then One Kings Lane. Fiscal 2019, at the end of fiscal 2019, they ended up divesting those, which caused this huge 32% decrease in locations in fiscal 2020, because I guess they wanted to focus on their main businesses, being Harmon, Bye Bye Baby, Bed Bath & Beyond, and Decorist. Here we can see their revenue and SG&A per square foot. A big red flag here is that we can see that in fiscal 2018, 19, 20, 21 is just steady increases in SG&A per square foot, whilst revenue stayed around the same. Here we can see it started off at $279 a square foot in revenue, and it ended in 2021 at $282 per square foot. And we saw massive decrease in square footage, increases in expenses. That's why it's not doing very good these days. Here we have our historical unlevered free cash flow. We can see total revenue is on a decrease. Gross profit margins were decreasing steadily, starting off from 34% and ending at 31%. Operating expenses, decreased, but that's a given because they have less stores to manage. However, we can see huge decreases in operating income. Their EBIT went from negative 87 million to 245 million into that fiscal 2021. As far as the unlevered free cash flow, it was positive in 2018 and ended negative in 2021. You could say at the end of the day they had negative operating income, negative net income, but they had positive cash flow. This was the case for the past 4 or 5 years, but last year and specifically it turned negative, which is a pretty bad sign. And we can also see that EBITDA went from 251 million to 48 million, which is not very good. Here we have their strategy. This is taken from their 10K. They want to focus on a digital first omni-channel growth strategy, and they want to focus on these 5 per se pillars, which is product, price, place, promise, and people. On the product side, they want to move to centralized ordering and replacing systems to optimize inventory. We'll see later that inventory is a huge problem for them right now. Price, they just want to be competitive with things like Amazon, so competitive price points. Place, they want to use data-driven store remodels and improve store productivity. Promise, they want to increase customer base, and people, they want to recruit people for corporate. I don't know. They've also switched from brands that they were using to their own, to their very own owned brands. We can see in the first quarter they added 3 brands: Nestwell, Haven, Simply Essential. In the second quarter, they added Our Table, Wild Sage, Squared Away, and in the third quarter they added Studio 3B and H for Happy. This is taken from their directly from their website. This top row is Wild Sage, the bottom is Simply Essential, and one of the biggest things that I see is that a lot of these items are clearance items and they're out of stock. So stockouts are obviously making them lose money, and they're pricing these things where their probably margins are pretty low. Same thing with the Simply Essential items. They're selling items $2.10, $4, $7. I don't really see how this can make an impact on their revenue. I granted you sell millions of items, but I'm not sure they're selling millions of plungers or, I don't know, small shower totes. I don't know. Going into our projections, I ended up doing 3 cases. Our upside case assumes on the revenue side that they'll have $296.17 in revenue per square foot, which is an increase from a 4.5% increase from fiscal 2021's $282 per square foot, and a 1% growth rate into perpetuity. The terminal value, which is fiscal 2032, will be at $327.16 per square foot. And it's also assuming that Bed Bath & Beyond store closures stop completely on the Bed Bath & Beyond side, increase on the Bye Bye Baby side, and Harmon store closures also stop. On the expense side, we assume that there's an $87 per square foot of SG&A expense, which is a 10% decrease from fiscal 2021, which was $96.50, and a 0.5% decrease per year in perpetuity, and it comes out to around $83 a square foot on the terminal value. And it also assumes that they maintain average cost of goods sold at 67.2% of revenue. Our weighted average cost of capital assumptions is that it'll stay at around 11.19%, and that their effective tax rate stays at around 17.2%. And we're going to be using the perpetuity growth method, and we're going to assume a 3% unleveraged free cash flow growth rate. These are the projections. We can see that the gross profit maintains at 32.8% because the cost of goods sold stays constant. We can see that their EBIT is actually positive throughout the projection. So fiscal year 2022, we see around 66 million in operating income, and it ends at around 450 million of operating income. Positive unlevered free cash flow, positive EBITDA. So looks like a good scenario. This scenario in particular gives us a 10 times implied terminal enterprise to EBITDA multiple, and an implied share price of around $40. So in this case, Bed Bath & Beyond would actually be trading at a significant discount. In our base case, the revenue assumptions assume $283 of revenue per square foot and a 1% growth rate into perpetuity, reaching $313 at terminal value. And it also assumes that Bed Bath & Beyond store closures continue to decline, except it'll be at a rate of 2.5% every other year compared to their average 8% decrease. And there will be an increase in Bye Bye Baby stores of around 1.6% per year, or every other year. And Harmon stores closures also increase by 1.8% every other year. On the expense side, we assume that there's $94 per square foot in SG&A expense, and a 5% decrease into perpetuity, reaching $89 at the terminal value, and that they maintain average cost of goods sold as a percentage of revenue of 67.2%. Same weighted average cost of capital, same effective tax rate, and the same unlevered free cash flow growth rate. And here are those projections. We can see that in the first year of the projection, we do have negative EBIT. Following into fiscal 2028, and where it then turns positive fiscal 2029 into fiscal 32. We can see that unlevered free cash flow, on the other hand, is negative just in the first year and continues positive throughout, which is, a better sign that they would be able to have cash in their bank account. They're not going to be scratched for cash. And in this scenario, we are trading at a 9.7 EBITDA multiple, and their implied share price is around 10.58%, which is at a premium currently. In the downside case, we're looking at revenue assumptions of $260 per square foot, which is a 4.5% decrease from fiscal 2021, and we're assuming a 0.5% growth rate in perpetuity, reaching $273.30 at terminal. Bed Bath & Beyond store closures would continue to decline in this scenario at 5% every other year, and increase in buybuy BABY stores of only 1% every other year. Harmon store closures would also increase by 2.2% every other year. On the expense side, we'd assume $103 per square foot in SG&A expense, which is a 10% increase from fiscal 2021, and a 0.5% decrease per year in perpetuity, reaching $83 at terminal. And this also assumes that it maintains a 67.2% cost of goods sold as a percentage of revenue, same weighted average cost of capital, same effective tax rate, and the same unlevered free cash flow growth rate. And in this scenario, we see that everything is gone to shit, basically. We're seeing negative operating income throughout, negative unlevered free cash flow in this scenario. That's basically Bed Bath & Beyond going bankrupt. We can see that the shares are basically worthless because this isn't sustainable and nobody would pay for a company that's losing this much money. Here we transition into a sensitivity analysis. We're going to see how, in this particular case, in the downside, how the terminal free cash flow growth rate and weighted average cost of capital would affect the implied share price. And in the downside case, it doesn't really matter what terminal free cash flow growth rate we use or what weighted average cost of capital we use, between 14 and 8%, because it's essentially worthless. The losses are unsustainable and nobody would invest in a company like this. In the base case, we see that obviously if the terminal growth rate increases, our share price increases, as well as if our weighted average cost of capital decreases and our terminal growth rate stays the same, we also see share price increases. And in our upside case, same thing, except we're seeing these at a way higher share prices. I mean, if we see a terminal growth rate of, say, 4.75% at the same weighted average cost of capital, we see that it'd be trading at $48 compared to $40 right now. And I think where this thing really becomes interesting is in the revenue per and SG&A per square foot sensitivity analysis. In the downside case, base case, and upside case, it really doesn't matter. Bed Bath & Beyond needs to reduce its SG&A expense per square foot or increase the revenue per square foot to maintain any kind of share price. We see in the worst case scenario, if they had a $98 a square foot in SG&A expense, they would need to have at least $312 in revenue to trade at least $1.73. And I mean, they're at this point right now, they're at $282 in revenue per square foot and $96 in SG&A expense. So there's a lot of work to be done in those two areas. And if they maintain those metrics, it doesn't matter in what case we look at it in. The share price is worthless. I mean, we can see in the downside case here in these highlighted zones, this is where their current expenses and revenue are at. It really doesn't matter. There's no way it'd be worth anything. Here we can see how their total equity value to revenue multiples are compared to companies in the same sector. So we have Bed Bath & Body Works, Sally Beauty Holdings, RH, Williams Sonoma, Lands End. They all sell home items, Bed Bath & Beyond type items, kitchen items. We can see that, I mean, if you look at it just on a multiple perspective, that they are trading at the lowest multiple compared to competitors. But I mean, compared to competitors, all of these guys actually have income. I think Bed Bath & Beyond is the only one who's losing money in this scenario. And if we compare this to total equity value to revenue of meme stocks, we can see that it's trading higher than GameStop and significantly lower than AMC. So AMC might be another one to look at. Maybe it's trading too high because GameStop is really the most popular short squeeze meme stock mania stock. And if Bed Bath and Beyond is trading higher than GameStop, it's kind of a red flag. And here's just some problems that I see with the company. This is off of their homepage. They're having a 80% off warehouse clearance event plus 20% off entire purchases with coupons and 2 times rewards point. They're just screaming that they need cash right now, and they're trying to unload inventory as fast as they can because obviously they're in a pretty bad spot. And this slide really dives into that. In fiscal 2021, they spent around $590 million on stock buybacks. They bought 27.7 million shares at approximately $20.75, and another 600,000 shares at $24.16. Just for reference, I think it's trading at around $9-10 today. So this is their definition of a back holding at this point, or they could have waited and maybe bought shares at this point, bought probably double the amount of shares that they did. When they could have used that money to fund their store remodels. In their 10K, they specifically say that in fiscal 2022 they plan on spending around 390 to 410 million in store renovations and other capital expenditures. And another problem here is that as of Q1 2022, they only have $107 million in cash. And in just between Q4 2021 and Q1 2022, they saw a decrease in cash flow of 332 million. I mean, just roughly doing the math in your head, I mean, they're not going to have enough money to get through the next quarter if they end up losing that much money. And final problem is that we're in a point in time where the Federal Reserve is raising rates. So it's going to be a lot harder for them to raise debt at a reasonable interest rate, especially with their credit rating and just have their financial status. And this last piece right here, we see that their cash and equivalents are again 107 million, but their inventories are around 1.8 billion, and this just goes back to that 80% off, that all these clearance items and inventory unloading. They're doing this because they do not have cash right now. So if you need some discounted Bed Bath & Beyond items, I think now is the time to get them, because there's going to be just a fire sale of kitchen items and bath items that you're going to be able to get your hands on, man. Or tell your mama, your auntie, your grandma that you need some Bed Bath & Beyond, baby. Other than that, I think that's all I have for you guys today. If you guys have any suggestions on other valuations you want me to do, leave them in the comments below. Other than that, like and subscribe, share. I don't know. Buy Bed Bath & Beyond or don't. I probably wouldn't. It's not financial advice. Do what you want. It's your money. Yeah, that's it.